A bank is a financial institution that accepts deposits from the customers and creates credit. As a customer, you may be seen as a potential target for fraudulent activities. 40 years ago, banking might have involved simply forging an account holder's signature on a withdrawal slip. Now the speed and intricacy of these activities are mind-boggling. For example, a bank account receives a payment of £10,000. Within minutes, the funds have been cycled through dozens of accounts before being forwarded to an international account, where the trail suddenly goes cold. No alarm bells go off. No inquiries are made to the bank. The fraud is only discovered much later, at which point the money and the fraudsters are long gone. Criminal hackers have found a way clearly outwitting the latest generation of online banking security devices given out by banks. We take a look at the 4 biggest and common bank frauds you might face. Some emails inform the customer that their security details and passwords need to be updated by logging into an authentic looking but fake website. The purpose of this website is to obtain your logon details to access your bank accounts. Others communicate security messages and advise you to install software from the email that checks and removes viruses. By downloading the software, you're in fact tricked into downloading a virus. Identity theft is where your personal details are obtained to get some sort of financial or other benefit, leaving you the owner of that identity, often in large debt with a negative credit history or in some cases with legal implications. Your information can be obtained in many ways. Theft, including theft of mail from your mailbox at home, telephone, fax and mail scam, internet, utility bills. When a credit or debit card is swiped through a skimmer, the device captures and stores all the details stored in the card's magnetic strip. Thieves use the stolen data to make fraudulent charges either online or with a counterfeit credit card. Credit card skimmers are often placed over the card swipe mechanism on ATMs and gas stations. With ATMs, the crooks may place a small, undetectable camera nearby to record you entering your PIN. This gives the thief all the information needed to make fake cards and withdraw cash from the cardholder's checking account. Cheque fraud is the use of a check to get financial advantage by altering the check without authority, theft of legitimate checks and then altering them, duplication or counterfeiting of checks, using false invoices to get legitimate checks, depositing a check into a third-party account without authority, depositing a check for payment knowing that insufficient funds are in the account to cover the deposited check. The aim is to trick people into handing over their card details or access to protected systems. Emails are sent out that contain either links or attachments that either take you to a website that looks like your bank's or installs malware on your system. A report by Verizon into data breach investigations has shown that 23% of people open phishing emails. In 2016, transactions made online or via phone, where the cardholder does not need to present the physical card to complete the purchase, jumped the most, increasing 40% compared to 2015. Thieves used stolen login information to access a consumer's account rose 31%, and instances where fraudsters opened new accounts in a consumer's name were up to 20%. In all, thieves stole $16 billion. The report found nearly $1 billion more than in 2015. The top 10 fraud types alone account for $181 billion in annual losses, and the numbers will keep increasing across most fraud types for 2017. Wire transfer fraud starts with phishing emails. These emails are used to trick into wiring money to bank accounts established by the criminals. Criminal sends an email with a spoofed sending address to one or more targeted recipients. A recipient replies, and the criminal continues the conversation and asks for a wire transfer. In 2016, thieves stole $46.7 million from Ubiquiti using this method. Since then, at least one organization has shared its experience as the target of an attempt at wire transfer fraud. Nowadays, internet banking is widely used to check account details, make purchases, pay bills, transfer funds, print statements, etc. Online banking fraud is a theft committed using online technology to illegally transfer money from one bank account to another bank account in a different bank. Debit or credit card fraud occurs when the information contained on your debit card is stolen and used to obtain funds from your account without your authorization. Card reading devices are used to obtain the electronic data from the magnetic strip on your card, and hidden cameras or false PIN pads are used to obtain your personal access code. Mortgage fraud is a crime in which the intent is to materially misrepresent or omit information on a mortgage loan application in order to obtain a loan or to obtain a larger loan than could have been obtained had the lender or borrower known the truth. Increasing numbers are lying about their finances in an attempt to secure a mortgage. The 23% rise in mortgage fraud comes as the lenders have tightened their borrowing criteria, making it harder for prospective homeowners to get a loan. Finance from Experience said 39 in every 10,000 mortgage applications made in 2016 found to be fraudulent. When customers open accounts or loans with no intention of repaying them or committing devious transactions to steal from the bank, they are committing first-party fraud. Expect first-party fraud to increase in 2017, particularly since lending programs are getting progressively riskier. Identity fraud has and probably always will rank in the top 10 fraud types. Fraudsters have bad credit, so they need to use someone else's to con the banks out of money. Identity fraud spiked up in 2016 in the US due to IRS tax refund fraud and the re-emergence of new account fraud at card issuers and banks. The good old-fashioned paper checks. Your grandma still uses them. Fraudsters still love them and write billions of dollars in fraudulent checks every year. The more banks think this fraud is going away, the more fraudsters prove them wrong. Auto lending fraud happens when borrowers or dealers lie about the income, employment, collateral value or identity during the application process. And given the fact that there was over $1 trillion in auto loans last year submitted by over 1 lakh dealers a year, the fraud risk runs high. Auto fraud can run as high as 50 to 200 basis points based on lender's portfolio. Expect auto lending fraud to increase next year due to increasing interest rates and rising car prices and more competition in the market. Account takeover fraud is a big and growing problem. Account takeover fraud is a form of identity theft in which the fraudster gets access to a victim's bank or credit card accounts through a data breach, malware, or phishing and uses them to make unauthorized transactions. The Oriema Group reported a whopping 280% rise in account takeover last year. Account takeover is being driven by huge breaches at Yahoo and LinkedIn. Since 50% of consumers use the same credentials across all of their online sites, fraudsters have been able to use brute force attacks to take over their online banking accounts. Fraud involving the Automated Clearinghouse Network (ACH), which is used by financial institutions to handle direct deposits, checks, bill payments, and cash transfers between businesses and individuals, is becoming an increasingly popular way for hackers to siphon money out of the bank accounts of unsuspecting victims. Fraudsters only need two pieces of information to pull off ACH fraud: a checking account number and a bank routing number. They typically obtain the information with a targeted phishing email that tricks the victim into running malicious software, which then allows the criminals to install keylogging software and steal bank account passwords. We believe it is the sleeping giant. Look out for this fraud to boom in 2017. Organizations need to get better at identifying whether users logging in are really who they say they are. That will require using multiple authentication methods and data points that can be applied depending on the risk involved in certain login or activity. They need to know who comes in and look them up and down. Pull together an ID-based behavioral analytics, device analytics and biometrics. Banks should look to set up a central fraud observatory or hub that can track trends across the channels and lines of business. This will enable institutions to track and react as fraudsters look for new vulnerabilities.